All right, all you option heroes, we are back. We are back. Options Greek. So, for those who don't know, and just a refresher for those who do know, options Greeks are nothing more than data points associated with every single option there is. Um, they let you know a few things. They let you know how much money you're going to make or lose if the stock goes up or down $1. They let you know what's your synthetic equivalent of stock. So you don't get stock with an option. What you do get is a synthetic equivalent for a much, much, much cheaper price. So there are options Greeks that let you know that. There are options Greeks will let you know how much value is going to be removed from an option every single day. And last but certainly not least, and definitely everyone's favorite, is they let you know the chances you're going to make money on a trade and on an options trade. So those are really cool. Without further ado, we're going to jump right in here. So the first option Greek we're going to talk about is delta. So delta does a few things. The first thing delta does is it measures the price movement of an option per every $1 move in the underlying stock, right? So depending on the delta, if the stock moves up or down $1, we have an expected outcome for the profit or loss from that option. So let's go over to the handy trading platform to see this. So we're going to do this in SPY, and obviously we're going to do it in SPY because we just went over the lesson about liquidity is the most important thing ever. SPY is the most liquid product in the world. So we're going to go ahead and check it out here. So we said that it measures the predicted price the predicted price movement of an option per every $1 move in the underlying stock. Great. So let's see this. Let's go find a call. So let's look at the 249 call. It has a 30 delta. Keep that in mind. Now remember, the first thing about delta is that it measures the predicted price movement of an option per every $1 move in the underlying stock. You can see here we are going to stress the position as if SPY is up $1. So right now it's down $1. We're going to set it to +1, right? So, right, 248, there you go. So what will happen if we own a 30 delta call and SPY goes up $1, how much should we make or lose on that option? Now remember, delta measures the predicted price movement of an option per every $1 move in the underlying stock. Let's simulate a buy. Great. So we simulate a buy. We're going to buy the 249. We're going to buy the 249 call for 76 cents. If SPY goes up $1, we make about $34. Now that's interesting. Remember, delta is it measures the predicted price movement of an option per every $1 move in the underlying stock, right? So 30 delta pretty much says, hey, all else things being equal and nothing else changing, if SPY goes up $1, that 249 call option, that's going to be worth like 30 cents more. So that's really awesome, right? So that's that part. Now, what else goes up that much money if SPY goes up $1? If we own 100 shares of SPY and SPY goes up $1, we should make about $100, right? So how many shares do we need to own so that if SPY goes up $1, we make $30, right? So exactly, we need to own 30 shares. So let's simulate that. Not 100, 30. Now, we're going to stress this here too. So what happens if SPY goes up $1? 30 shares are going to each be worth $1 more, and we're going to make right around $30. So very, very interesting. And let's go ahead and look at that one more time. We bought a 249 call for just 76 cents. That's per share. Every option is worth 100 shares of stock, so that's $76 we paid. And if the stock goes up $1, we make right around $30. Now the same thing goes if we bought 30 shares of SPY for, let's see how much that's going to cost. So 246.91 times 30, so that's going to cost us about $7,500. right? So for $7,400, $7,400, if SPY goes up a buck, we make about 30 bucks. Makes total sense. Every share is worth $1 more times 30, 30 bucks. Now, on the other hand, we paid $76, a cool 1% of what it took to get 30 shares of stock. And if SPY goes up a buck, we make also that $30. So very, very interesting. So what it seems to me, because of this, is not only does delta, again, number one, it measures the predicted price movement of an option per every $1 move in the underlying stock, but as you probably saw already, it also measures how many synthetic shares of stock we actually have. Now this is quite interesting. Delta's a really, really important one here, guys. Let's do it with a different option. Let's do the 247 and a half call for $1.49. So together, if we want to go ahead and purchase this option, for it has a 45 delta. If we want to purchase this option, we pay $149, right? To get this, that is to get us a synthetic equivalent of 45 shares of stock. So if we want to go ahead and buy 45 shares of stock, that's going to cost us almost $11,000. So again, for about 1% of the price, we're going to get the same price movement. So let's buy 45 shares of stock here. This is the same thing. Look, if it goes up a buck, we make about 45 bucks for the 247 and a half 45 delta call. If we own 45 shares and it goes up a buck, we make about the same type of money. So again, it's not only is it how much is the option going to move up or down for a $1 price movement in the stock, but it's also your synthetic equivalent, right? So let's say we were bearish on SPY. We were bearish and we thought the market SPY would go down, right? One of the things you could do is you can go ahead and buy the 247 put. You're going to end up paying $156 for that, right? Nothing crazy. That is going to give you negative 50 deltas. Negative 50 deltas, right? So now we're betting it goes down, right? Negative 50 deltas. And if SPY goes down a buck, we make $55. So right around there again. The synthetic equivalent of stock of an option is its delta. We have negative 50 deltas, right? Negative 50 deltas when we buy this option. And when we stress the position going down a buck, we make about 55 bucks, so right around 50. And this is going to be the same thing as if we were selling 50 shares of stock, right? Here, we make 50 bucks, so it's the same thing. It's the exact same thing for, again, fractions of the cost. So that's really cool. Delta tells us a lot of things. Let's go over that again real quick. What is delta? Delta does two things. Not only does delta measure the predicted price movement of an option per every $1 move in the underlying stock, but it also tells us what our synthetic equivalent of stock is for every single option. So that's all an option is. All an option is synthetic shares of stock for significantly lower. Now remember, let's do that. Let's do another example again with that. Now 248. We're going to pay $122 to get 41 shares of stock. To get 41 shares of stock. If SPY goes up a buck, we expect to make something very close to the delta, and that's what happens here. Now, how do we do that with stock? We go ahead and buy 41 shares of stock because delta is the synthetic equivalent of stock. And what do we end up with? Same thing. We make about 41 bucks if SPY goes up $1, right? So that is really, really good stuff, guys. That's really, really good stuff. Let's see what else we have here. So that is delta. Again, measures the predicted price movement of an option per every $1 move in the underlying stock. Not only that, but it also tells us what our synthetic share equivalent is of stock in an option. That is awesome. Now, gamma. Gamma is the second Greek we're going to talk about. Gamma is kind of a daughter or son of delta. It's a derivative of delta. And gamma measures the change in the value of an option's delta per every $1 move in the stock. Now, a lot of you are probably saying, Stephen, we bought this 30 delta call, and when it was stressed up a buck, it made a little bit more money than the $30 we were expecting to make, right? That is because of gamma. So gamma says, and let's take a look here. Gamma says per every $1 move of stock, the delta will change accordingly to the gamma. So the 249 call that starts with a 30 delta, which says again, it's like owning 30 shares of stock. If SPY goes up a buck with the 30 delta call, we expect the value of that call to increase by about 30 points. But gamma is now saying that if SPY moves up or down a dollar, gamma is added to the delta. So what we expect to happen is this. If SPY goes up a dollar, we expect the delta to end up being $39, right? So that's why we make a little bit more money here on the 30 delta call as opposed to just straight up 30 bucks, because though it's ever changing, it's very elastic, it's dynamic. Delta changes all day, every single day until an option expires. So what do we see when delta goes up? When SPY goes up a buck, delta is now 9 points, 9 gamma, right? 9 points is added to delta. Now delta, the 249 strike becomes a 39 delta, right? So now instead of having the synthetic ownership of 30 shares of stock, if SPY goes up a dollar, because we have a positive 9 gamma on the 249 call, the delta now will be about 39. And instead of having the synthetic equivalent of 30 shares, we will have the synthetic equivalent of 39 shares, right? So that's what gamma is. Between you and I and everyone else who's listening, anyone else who cares, gamma is totally not important. Delta is super important. It's really, really important. Gamma, on the other hand, not that important, not really a big deal. It's not something you're ever really going to look at. So don't worry about it. However, it's good to kind of understand how these things work out. Theta, on the other hand, is something that is critical. So we mentioned that there's a Greek that allows you to know how much value is extracted from every single option every single day, right? That's theta. So theta measures the change in the price of an option from one day to the next, and it's negatively happening. So let's go back into our trading platform and look at theta. So theta on this 249 call says if the stock does not go up or down, or if implied volatility doesn't move at all, we expect that this option will have 3 cents removed from it. So let's say nothing happens in SPY tomorrow. Nothing happens in SPY tomorrow, right? If we're saying that the mid price on this is 76 cents, at the end of the day tomorrow, 3 cents will have been removed from this option, and this option will be worth 73 cents. 73 cents. So that's what delta is. Now, that's what theta is. Now, all of these options have a theta component. Unless they're worth 0, they have some sort of value that's getting removed from them every single day. Now, as you can see, the closer we get to the at the money strike, the greater theta is and the more is extracted in terms of value from an option every single day. So we see if we buy this 255, right? Fractions of pennies we're expecting to get removed per day. So it's like 88.88 out of one full theta is getting removed every single day. But as we get closer to the at the money strikes, like this 248 strike, we expect 4 cents to get removed from this option every single day. So again, theta is the amount of money that's extracted from every single option every single day. Every single option has it, and the closer we get to the money, the greater the theta component is. Cool. Let's move on to the last one. Vega. Vega measures the change in the price of the option per every $1 change in the implied volatility of the underlying stock. So this is something that is not 100% critical to know at this point. However, it's just a good thing to know. So what Vega says is, if the expected move or implied volatility goes up a dollar, then we expect that the price of the option will go up accordingly with our Vega. So let's say this 247 put, right? And we're going to buy it for $1.56. This has a 23 Vega. So if the expected move over the course of the next year, which is implied volatility, goes up by $1, the price of this option, the price of this option will go up by 23 cents, right? So that's all it is. Not really a big deal, not really, really important for right now, right? So let's just go over really quick before we get into the next section. Let's just go over really, really quick these 4 options Greeks. They're not ultra important. Delta is really important. Theta is really, really important. Gamma and Vega, far less important. So again, delta is 2 things. Number 1, it measures the predicted price movement of an option per every $1 move in the underlying stock. And the second thing it does is it lets us know how many synthetic shares of stock we have per option. Super, super important, super, super helpful. Rather than buying 50 shares of stock, we could buy a 50 delta call and be able to have synthetically the same amount of stock for 1% of the price, or a 99% discount, like a dollar store or something. It's ridiculous. Gamma, which is not very important, but good to know, measures the change in the value of an option's delta per $1 move in the underlying. If we have a 50 delta call and we have a gamma of 10 and SPY moves up a dollar, that delta will on that option will be 60. Pretty straightforward. Theta, on the other hand, super important. It measures the change in the price of an option from one day to the next, right? So this is how much value is removed from an option every single day. And as we get closer to the at-the-money strikes, it is a greater theta component. So theta is highest, closest to the at-the-money strikes. And then Vega, not really important as of right now. It measures the change in the price of the option per every 1% change in the implied volatility of the underlying stock.